Hi everyone. We're here today to talk about SME finance. That's basically small and medium enterprise finance. When we consider SME finance, this basically refers to financial products and services designed to meet the specific needs of small and medium enterprises, which is what we refer to as SMEs. Now, SMEs are typically defined by their size, but the exact criteria of what a small or a medium enterprise is will vary by country to country. And it'll also vary by organization to organization, in the sense that whichever regulatory authority or body we are looking at to give this definition will view it a little differently. In general, SMEs are businesses that have relatively fewer employees and lower annual revenues. That means there's two criteria that you can see universally: the number of employees, as well as the amount of revenue that is to be generated. These are two base criteria for determining a small or a medium enterprise. And this is always done in comparison to large corporations. So there's going to be a range that will identify for the number of employees or the revenue generation capacity of a small enterprise and the number of employees and the revenue generation capacity of a medium enterprise. Now, the financial needs of SMEs are distinct from those of larger enterprises. And when we consider SME finance, it aims to address these unique requirements. If we consider some key aspects of SMEs, it's important to keep the following points in mind. And the first and foremost on that list is credit facilities. Credit facilities basically means that SMEs often require access to credit for various purposes. And these can include working capital, expansion, or equipment purchases. Now, credit facilities may come in the form of loans. It can come in the form of lines of credit or even in the form of trade finance. Another key aspect is working capital financing. That's working capital financing. Now, what do we mean by this? So many SMEs face fluctuations in cash flow, especially those in seasonal industries, and this is key for seasonal industries. So working capital financing helps SMEs manage their day-to-day operational expenses, such as purchasing inventory and converting short-term liabilities. Then there's the idea of microfinance. Now, microfinance is something that we will look at in greater detail a little bit later, but this is where, in some cases, SMEs are very, very small businesses or startups, and they may not even qualify not only for traditional bank loans, but they may not even qualify for small business loans. And so we've got special institutions known as microfinance institutions, which provide smaller loans tailored to the needs of micro entrepreneurs and micro businesses. Trade finance is another category to understand. So trade in SMEs are basically SMEs that are engaged in international trade may require financing for import or export goods. So trade finance solutions can include letters of credit, import and export financing, and other instruments to facilitate cross-border transactions. The fifth category to keep in mind is asset financing, and this is most common. So what do we mean by asset financing? SMEs often need to acquire or upgrade equipment or machinery or even vehicles based on the nature of their business. And asset financing allows businesses to spread the cost of these acquisitions over time. This is essentially the purchase of fixed assets. Another area is venture capital and private equity. It's venture capital and private equity. Now, startups and high-growth SMEs may seek equity financing from venture capital firms or private equity investors, and their main purpose in this regard is to fund expansion, to fund research and development, or some other strategic initiative from the perspective of their business. There is a small area, a growing area, essentially, within our economy of Islamic finance, and Islamic finance specific to small and medium enterprises. So you'll see this in regions where Islamic finance is prevalent because SMEs can access Sharia-compliant products and services that adhere to the Islamic principles, such as the profit-sharing arrangements of Mudaraba and the cost-plus financing of Murabaha. In terms of financial advisory services, SMEs, this is a key area here, right? In terms of diversification. So we've also got the area of financial advisory services. So in financial advisory services, SMEs can benefit from financial advisory services that help them make informed decisions about financing options, about risk management, and their overall financial strategy as they pursue business. Government-backed programs are a key element within SME financing. So government-backed programs. We'll often see this in changes of governments. So many governments will offer special programs and incentives to support SMEs. This could include subsidized interest rates. This could include grants, and it could include other financial assistance programs depending upon the economic focus of that particular government or that regime. And lastly, we have the idea of technology-enabled solutions. Technology is a key player. So technology-enabled solutions is critical here. So the rise of financial technology, or fintech, has essentially introduced innovative solutions for SMEs. We have online lending platforms, we have digital payment systems, and we've got automated financial management tools, which have essentially increased the scope of banking and finance for small and medium enterprises. Now, essentially, if we keep all of this in mind, we understand that SME finance is crucial for the growth and sustainability of small and medium-sized businesses. And there's various areas of financing that we need to cater to for SMEs, because it provides them with the necessary capital and financial tools to navigate challenges and to seize opportunities. As the landscape of SME finance continues to evolve with a growing emphasis on financial inclusion, technological advancement, and tailored solutions to meet diverse needs of SMEs across different industries and regions. Now, this was a basic overview, but if we look at this core idea that a small business is not a little big business, this is an article that we've seen in from Harvard Business Review, and it's got these wonderful elements. So if we were to highlight the key points of how a small business is not a little big business, so that idea of analysis of large corporations can't just be shrunken down in size and applied to small and medium enterprises. Why? Well, there's 10 key points that we need to understand and how these two vary. And so first and foremost, we have our resource constraints. Small businesses typically operate with limited resources, both in terms of finances and personnel. So unlike larger corporations, they may not have the same scale of funding, of infrastructure, or of manpower. Then there's the idea of flexibility and adaptability. There we go. The flexibility and adaptability. Now, small businesses will often have the advantage of being more agile and adaptable compared to larger organizations. This is an advantage for them. They can quickly respond to market changes. They can quickly respond to customer feedback and any emerging trends within the market. Then we've got personalized customer relationships. Personalized customer relationships. Now, small businesses have another major advantage. They can build strong, personalized relationships with their customers. They often have a deeper understanding of their customer base, and they can provide more tailored and intimate customer experiences. And of course, there's that idea of the entrepreneurial spirit. This entrepreneurial spirit is key to success. Why? Because it is the driving force in a small business. So owners are often deeply involved in the day-to-day operations. They wear multiple hats, they play multiple roles within the organization, and they're directly connected to the success of the business. Then we've got innovation and creativity. This is also critical. Small businesses not only foster a culture of innovation and creativity, they've got fewer bureaucratic layers, which means there's often more room for experimentation and pursuing novel approaches to problem solving. Risk management, of course, for small organizations is very different. The small business can approach risk very differently. Larger corporations may have very extensive risk management processes, whereas small businesses rely on that entrepreneurial intuition. And while they tend to have a greater willingness to take calculated risks. And of course, the biggest advantage of small businesses is their local impact. They play a crucial role in their local economies. They contribute to communities' development, they provide employment opportunities, and they can have more immediate impact on the neighborhoods that they operate in. Now, there are certain operational challenges that they face, and this is undeniable. Small businesses face distinct operational challenges such as limited scalability, a need for efficiency in operations, and the necessity for owners to balance multiple responsibilities. If we look at financial management in a small business, financial management in small businesses is often far more hands-on than in large corporations. So owners may be directly involved in budgeting, in financial planning, and in ensuring the business's financial health. The long-term vision for small businesses is also very different. They tend to focus on sustainable growth and long-term relationships rather than immediate market dominance. It can be argued that this is directly associated to resources and scalability, but essentially it represents an advantage for smaller organizations. So building a strong foundation and reputation within a niche market could be a primary goal for small enterprises. So when we understand and appreciate all of these differences, it's crucial for small business owners, understanding them is critical for small business owners and entrepreneurs. It enables them to leverage their unique strengths, to navigate their challenges effectively, and to build a business model that aligns with their scale, their resources, and their aspirations. Now, considering the specific context of small and medium enterprise financing in Pakistan, there are 10 key points that you really should know here. Let's go ahead and open up number one. So the first element is our diverse sector presence. Diverse sector presence. So essentially, when we consider the diverse sector presence, what we mean is that the SME finance industry in Pakistan caters to a wide range of sectors, including manufacturing, services, agriculture, and trade. And so this diversity reflects on the varied nature of SMEs within the country. If we were to elaborate on this a little bit further, okay, essentially what we mean is that the diverse sector presence within the SME finance industry in Pakistan highlights the wide range of economic activities that they engage in. So first and foremost, we could consider the manufacturing sector. And in the manufacturing sector, SMEs in manufacturing cover a broad spectrum, ranging from small workshops producing handmade goods to more sophisticated operations involved in lighter heavy manufacturing. And so the financing needs in this sector may include funding for machinery, working capital, technology upgrades, and expansion of production capabilities. And when we look at it from the services sector perspective, the services sector includes a variety of businesses such as IT services, consulting, healthcare, education, and hospitality. And so financing requirements for service-based SMEs may involve, again, investments in technology. It could also include employee training, marketing, and infrastructure improvement. When we see it from the agriculture sector perspective, agriculture is a significant contributor to Pakistan's economy, and many SMEs operating in this sector, including family-owned farms and agribusinesses. Finance for agriculture SMEs may be required for purchasing equipment, seeds, fertilizers, and meeting working capital needs during different agricultural cycles. Businesses in the trade and commerce sector, so SMEs engaged in trade and commerce, play a pivotal role in connecting producers and consumers. This sector includes wholesalers, retailers, importers, and exporters. Financing needs for trade-focused SMEs may involve inventory management, import-export financing, and adapting to market trends. Then we have retail and consumer goods. This would be trade and commerce, obviously. Retail and consumer goods. Retail SMEs, including small shops and boutiques, form a vital part of the economy by certain local communities. Financing in this sector will be required for stocking inventory, enhancing store infrastructure, and adopting technology for better business management. For construction and real estate management. For construction and real estate, SMEs in construction contribute to infrastructure development, while those in real estate engage in property development, management, and related services. Financing needs may include project financing, working capital for construction projects, and investment in real estate ventures. In terms of technology and innovation, with the growth of the digital economy, many SMEs in Pakistan operate in the technology and innovation space. Financing requirements for tech SMEs may involve research and development, hiring skilled personnel, and investing in technology infrastructure. Health and pharmaceuticals. SMEs in healthcare and pharmaceutical sectors play a crucial role in providing medical services and producing pharmaceutical products. Financing needs may include investment in medical equipment, research and development, and compliance with industry regulations. And so from this list, you can see that diverse sector presence, the diverse nature of SMEs in Pakistan, means that the SME finance industry must be adaptable and responsive to the unique needs of each sector. Financial institutions offering SME financing need to understand the specific challenges and opportunities within these sectors to provide tailored and effective financial solutions. Additionally, this diversity underscores the resilience and dynamism of the SME landscape in contributing to the overall economic development of Pakistan. Now, this was the first key factor that you need to understand about SME finance in Pakistan. The second area that you must understand is government initiatives. Now, when we consider government initiatives, notice that the Pakistani government has introduced several initiatives to support SMEs, including special financing programs, subsidies, and capacity building programs. So understanding these initiatives is crucial for SMEs seeking financial assistance. Now, these government initiatives play a pivotal role in fostering the growth and sustainability of small and medium enterprises. In the context of Pakistan, the government has implemented various programs to support SMEs, recognizing their significance in economic development. If we were to elaborate on some of these initiatives, it's as follows. So first and foremost, we have our special financing programs. The government often collaborates with financial institutions to create special financing programs tailored for SMEs. These programs may offer subsidized interest rates, longer repayment terms, or reduced collateral requirements to make financing more accessible for small businesses. Specific funds might be allocated to support startups, women-owned enterprises, or businesses operating in specific sectors deemed critical for economic development. The second area is subsidies and grants. Subsidies are financial assistance provided by the government to offset the costs of certain activities or inputs. For SMEs, subsidies may be directed towards areas such as technology adoption, energy efficiency, or export promotion. Grants, which are non-repayable funds, may be offered to SMEs for research and development, innovation, or participation in international trade fairs. These funds aim to encourage entrepreneurship and innovation. Then we have capacity building programs. Recognizing the importance of skills and knowledge for SMEs, the government initiates capacity building programs. These programs provide training and education on various aspects of business management, financial literacy, and industry-specific skills. Capacity building initiatives may include workshops, seminars, and training sessions conducted in collaboration with educational institutions, industry experts, and business development organizations. We have technology adoption support. Governments may encourage SMEs to embrace technology by providing incentives for the adoption of digital tools, e-commerce platforms, and other technology-driven solutions. This is particularly relevant in an area where digital transformation is key to competitiveness. So incentives may include tax breaks for technology investments, support for the development of digital infrastructure, and training programs to enhance digital literacy among SMEs. Then there's also export promotion schemes. And in export promotion schemes, essentially to boost international trade, the government may introduce schemes that provide financial support to SMEs engaged in export activities. This could include subsidizing export-related costs, facilitating market access, and offering credit insurance for export transactions. Trade promotion events such as trade missions and international exhibitions may also be supported to connect SMEs with potential overseas buyers. And lastly, we have policy reforms and regulatory support. Governments may undertake policy reforms to create a more conducive environment for SMEs. This can include simplifying regulatory procedures, reducing bureaucratic hurdles, and ensuring a business-friendly legal framework. Transparent and consistent regulatory policies contribute to a more stable business environment, encouraging SMEs to invest and grow. Now, overall, from these 6 points, understanding these government initiatives is crucial for SMEs seeking financial assistance. Entrepreneurs and business owners should actively engage with relevant government departments, industry associations, and financial institutions to stay informed about available programs and take advantage of the support measures provided. This knowledge empowers SMEs to leverage these initiatives for their growth, development, and overall success in the business landscape. Now, these are the first 2 points. The third point is challenges. Challenges in access to finance. Okay, so in terms of challenges in access to finance, despite government efforts, SMEs in Pakistan often face challenges in accessing finance, and this is due to factors such as limited financial literacy, lack of collateral, and risk aversion among traditional financial institutions. If we were to elaborate on this further, we'd also need to understand that access to finance remains a significant challenge because, so first and foremost, as we just mentioned, there's limited financial literacy. Many SME owners and entrepreneurs may have limited financial literacy, which hinders their ability to navigate complex financial processes, to understand loan terms, and to effectively manage their finances. A lack of understanding about financial statements, creditworthiness, and various financing options can result in SMEs being ill-equipped to present a strong case to financial institutions. Second is a lack of collateral. What do you mean by lack of collateral? Well, traditional financial institutions often require collateral as security for loans. However, many SMEs may lack substantial assets or have difficulty providing the necessary collateral. And this becomes a barrier, especially for startups and businesses in certain sectors where physical assets are limited, such as service-based industries. Next is a risk aversion among financial institutions. The financial institutions, including banks, may exhibit risk aversion when dealing with SMEs, perceiving them as higher risk borrowers compared to larger, more established corporations. The lack of credit history and financial track record from many SMEs can contribute to this risk aversion, making it challenging for them to secure financing on favorable terms. Another element is high interest rates. Now, when we consider this from a financing perspective, SMEs may face higher interest rates compared to larger enterprises, partly due to the perceived risk associated with lending to smaller businesses. The combination of high interest rates and potentially unfavorable loan terms can make it financially burdensome for SMEs to repay loans, affecting their overall financial health. Then we also have inefficient loan approval processes. Inefficient loan approval processes. Lengthy and complex loan approval processes can be a deterrent for SMEs. Many small businesses require quick access to funds for working capital or time-sensitive projects, and delays in loan approvals can impact their operations. Cumbersome paperwork, bureaucratic processes, and slow decision-making by financial institutions contribute to these inefficiencies. There's also certain challenges of the informal economy. In Pakistan, a significant portion of SMEs operate in the informal economy, and this poses challenges in terms of documentation, making it difficult for such businesses to provide the necessary financial records required by formal financial institutions. Informality can also lead to a lack of transparency, further contributing to the perceived risk by lenders. There's also a mismatch of financing products. So the financing products offered by traditional financial institutions may not always align with the diverse needs of SMEs. For example, long-term loans may not be suitable for businesses with short-term capital needs. So tailoring financial products to the specific requirements of SMEs is crucial for addressing this mismatch. Addressing these challenges can require a multifaceted approach involving collaboration between the government, financial institutions, and the SME community. Now, how can we essentially address these challenges? Okay, so first and foremost would be financial education through financial education and training. Increasing financial literacy through training programs can empower SME owners to make informed financial decisions. Another solution could be called collateral alternatives. Exploring alternative forms of collateral or risk mitigation, such as credit guarantees and government-backed loan programs, can provide security for lenders. And there's also risk mitigation strategies that can be pursued. So implementing risk-sharing mechanisms between the government and financial institutions can encourage banks to be more open to lending to SMEs. Furthermore, streamlining the loan approval processes, improving the efficiency of loan approval processes, embracing digital technologies, and reducing bureaucratic hurdles can expedite the disbursement of funds. Then we've got innovative financing models. Exploring innovative financing models such as peer-to-peer lending, crowdfunding, and impact investing can provide alternative sources of funds for SMEs. So all in all, by addressing these challenges, the government and financial institutions can create a more conducive environment for SMEs to access the financing needed to thrive and contribute to the economic growth of Pakistan. So these are the first three key areas of what we need to understand SMEs in finance. Number 4, the fourth key area that you need to understand is the emergence of fintech. And this is a global phenomenon. But the advent of financial technology, fintech, has started to address some of the challenges faced by SMEs. Online lending platforms and digital financial services are gaining popularity, offering quicker and more accessible financing solutions. So this has brought about significant changes in the financial landscape and in terms of how SMEs can access and manage their financing or their finances. There are 10 key points to understand under the emergence of fintech. The first one is quicker access to financing. Quicker access to financing. Fintech platforms offer streamlined and efficient processes for loan applications and approvals. Unlike traditional banks that may have lengthy approval procedures, fintech lenders leverage technology to assess creditworthiness rapidly, providing SMEs with quicker access to financing. And of course, there's digital lending platforms. Online lending platforms are a key component of fintech in the SME finance space. These platforms connect borrowers directly with lenders, often utilizing algorithms and data analytics to assess credit risk and determine loan terms. This direct and digital approach reduces the need for extensive paperwork and speeds up the lending process. Number 3, this is a data-driven decision-making process. Data-driven decision-making. So fintech Platforms leverage big data and advanced analytics to make data-driven lending decisions. They assess various data points, including transaction history, social media activity, and business performance metrics to evaluate the creditworthiness of SMEs more comprehensively. There's also the idea of accessibility and inclusivity. Fintech solutions enhance financial inclusion by reaching SMEs that may have been underserved by traditional financial institutions. This is particularly beneficial for businesses in remote or underserved areas that may face challenges in accessing physical bank branches. Alternative credit scoring models. Fintech lenders often use alternative credit scoring models that go beyond traditional credit history. This allows SMEs with limited credit history or unconventional financial profiles to access financing based on a broader set of parameters. There's also flexible financing options. Fintech lenders often use alternative credit scoring models that go beyond traditional credit history. This allows SMEs with limited credit history, flexible financing options. Fintech platforms offer a variety of financing options, including long-term loans, lines of credit, invoice financing, and peer-to-peer lending. This flexibility allows SMEs to choose financing solutions that align with their specific needs and their business model. There's also a reduced dependency on collateral. So where traditional lenders often require substantial collateral as security for loans, fintech lenders, through their data-driven approach, may be more willing to extend credit based on the business's performance, reducing the dependency on physical collateral. We also have technology adoption and integration. Fintech encourages SMEs to adopt digital tools for financial management. Many fintech platforms integrate with accounting software, providing real-time insights to the financial health of the business and facilitating better financial decision-making. Then we also have cost efficiency. Fintech platforms often have lower operating costs compared to traditional banks. This cost efficiency can translate into lower interest rates and fees for SME borrowers, making financing far more affordable. And last but not least, there is the idea of global reach. Some fintech platforms operate on a global scale, enabling SMEs to access international markets and financing sources. This can be particularly beneficial for businesses engaged in cross-border trade. So all in all, based on these 10 points and the emergence of fintech in our local economy, the emergence of fintech in SMEs represent a paradigm shift in how businesses manage their financial needs. By leveraging technology, fintech platforms are not only addressing challenges faced by SMEs, but also reshaping the financial industry, making it more inclusive, efficient, and adaptable to the dynamic needs of small and medium enterprises. The fifth area to understand in SMEs in Pakistan is the importance of credit information. The credit information bureaus play a vital role in assessing the creditworthiness of SMEs. Entrepreneurs should be aware of the significance of maintaining good credit records to enhance their chances of securing financing. The importance of credit information, especially in the context of SMEs, cannot be overstated.
Now, in terms of SMEs and SME finance, let's consider the importance of credit information. Credit information bureaus play a vital role in assessing the creditworthiness of SMEs. Entrepreneurs should be aware of the significance of maintaining good credit records to enhance their chances of securing financing. Now, in this particular context, especially as a developing nation, their role cannot possibly be overstated. When credit information bureaus, or CIBs as we refer to them, evaluate the creditworthiness of business, then entrepreneurs should be aware of the significance of maintaining positive credit records to enhance their chances of securing financing. Now, to elaborate on this topic further, we're going to first consider creditworthiness assessment. And creditworthiness assessment. Okay, so creditworthiness assessment is where credit information bureaus gather and maintain credit-related information on businesses and individuals. This information includes credit histories, outstanding debts, repayment behavior, and other relevant financial data. Financial institutions, including banks and other lenders, rely on this information to assess the creditworthiness of SMEs seeking financing. A positive credit history is a key indicator of a business's ability to manage and repay debt. Then comes the idea of access to financing. Maintaining a good credit record enhances an SME's access to financing, and lenders use credit reports from credit bureaus to evaluate the risk associated with lending to a particular business. A positive credit history increases the likelihood of loan approval and may result in favorable terms, such as lower interest rates. Building trust with lenders is also essential. A positive credit history builds trust between the SMEs and the lenders. It demonstrates a track record of responsible financial management and a commitment to meeting repayment obligations. This trust is essential in establishing long-term relationships with financial institutions. Competitive advantage is also important here. So SMEs with strong credit histories may have a competitive advantage when competing for financing. Lenders are more inclined to extend credit to businesses with a proven ability to manage their financial obligations, giving such businesses a favorable position in the market. And of course, this leads to a diversification of funding sources. Okay. So a positive credit history enables SMEs to diversify their sources of funding. Beyond traditional bank loans, businesses with good credit records may attract interest from alternative lenders, investors, and other financial partners. Of course, this can also lead to lower cost of capital. Remember, it's all about establishing credibility. So businesses with good credit records are likely to qualify for loans with lower interest rates, and a lower cost of capital positively impacts the overall financial health of SMEs, making it more cost-effective to fund operation expansions or strategic initiatives. And of course, there is credit monitoring and improvement. Now, as a process, if we look at this, entrepreneurs can use credit reports from credit bureaus to monitor their credit standing and identify areas for improvement. Regularly checking credit reports allows businesses to address any inaccuracies, rectify late payments, and take proactive steps to maintain a positive credit history. And of course, we've got the impact on supplier and customer relationships. And what we mean by this is that beyond the lending relationship, a positive credit history can influence relationships with suppliers and customers, because suppliers may offer favorable terms, trade credit terms, and customers may view a business with good credit as a reliable and stable partner. This further leads to opportunities in terms of government programs and incentives. So in some cases, government programs and incentives for SMEs may also consider creditworthiness as a criterion. Businesses with positive credit histories may be eligible for certain financial support programs or preferential treatment in government initiatives. And lastly, we've got financial inclusion. The availability of credit information contributes to financial inclusion by allowing a broader range of businesses, including SMEs, to participate in the formal financial system. This, in turn, supports economic development and growth. So overall, you can see that in the case of Pakistan, where SMEs play a significant role in the economy, entrepreneurs should actively manage and monitor their credit histories. Pakistan has credit bureaus like the Credit Information Bureau of Pakistan, the CIBP, and entrepreneurs should engage with these bureaus to understand their credit reports, address any issues, and strategically position their businesses for favorable financing terms. As the financial ecosystem evolves, awareness of credit information and its impact becomes increasingly critical for SMEs in Pakistan. Now, once we've discussed this area, The next thing that we can identify is the role of microfinance institutions in the success of SMEs. But this is an area that we're going to put on hold because the next lecture covers all of the intricacies of microfinance and the role that they have in terms of development, especially in underdeveloped economies. But in general, you should understand that microfinance institutions in Pakistan often focus on providing financial services to micro and small enterprises in rural and underserved areas. This is one of the reasons that we see this as an entire separate category. So understanding the offerings of these institutions is important in such regions. We're going to go ahead and go to the next point, which is the risk management aspect. So SMEs need to have robust risk management practices in place. Financial institutions, as well as SMEs themselves, should be aware of industry-specific risks and work collaboratively to mitigate them. In this perspective, we want to elaborate a little bit more. So the importance of risk management for SMEs cannot be overstated. Robust risk management practices are essential for both financial institutions and for the SMEs themselves. To elaborate further on why this is crucial and how financial institutions and SMEs can collaboratively mitigate industry-specific risks, we're going to first discuss the importance of risk management for SMEs. Risk management for SMEs. So the first area comes from the aspect of financial stability. Okay, so when we address financial stability, we're basically saying that effective risk management helps to maintain the financial stability of SMEs. By identifying and mitigating potential risks, businesses can avoid financial crises and ensure sustainable growth. Then we've got the idea of business continuity. And risks such as economic downturns, natural disasters, or supply chain disruptions can threaten the continuity of SME operations. So proper risk management allows businesses to develop contingency plans and strategies to navigate unexpected challenges. And of course, there's access to financing. And this is something that you'll see keeps coming up over and over again with SMEs. But financial institutions are more likely to extend credit to SMEs with strong risk management practices. A well-managed business is perceived as a lower risk and therefore increasing the likelihood of loan approvals and favorable terms. And this automatically leads to the aspect of compliance and governance. And so implementing risk management practices helps SMEs adhere to regulatory requirements and governance standards. This is crucial for building trust with stakeholders, including investors, customers, and regulatory bodies. Risk management is also important from an informed decision-making perspective. And so risk management provides valuable insights that contribute to informed decision-making. SMEs can assess the potential impact of risks on their business and make strategic decisions to mitigate or capitalize on those risks. Then we have strategic planning, and strategic planning basically means identifying and understanding risks and is integral to strategic planning. So SMEs can align their goals and initiatives with risk management strategies, ensuring that they are better prepared for uncertainties in the business environment. Now, remember, we were trying to see risk management, not just from the perspective of SMEs, but from the perspective of collaboration between financial institutions and SMEs in risk management. So this is the perspective specifically that we want to elaborate on now. And so the first thing that we want to emphasize is clear communication. Financial institutions and SMEs should maintain open and clear communication channels. SMEs must transparently communicate their risk profile, business plans, and strategies to financial institutions, facilitating a better understanding of potential challenges. Secondly, we have customized risk solutions. Why is this important? Well, financial institutions can collaborate with SMEs to design customized risk management solutions, tailoring risk mitigation strategies to the specific industry, size, and nature of the SME enhances the effectiveness of risk management efforts. Then, of course, we have risk assessment workshops. Conducting risk assessment workshops jointly with financial institutions and SMEs can be beneficial. These workshops can help identify industry-specific risks and develop proactive strategies to address them. Of course, there's access to expertise. And when we consider access to expertise, we have to note that financial institutions often have expertise in risk management. They can provide guidance, resources, and tools to help SMEs implement effective risk management practices within their organizations. This also leads to risk-sharing mechanisms. So logically, financial institutions may consider risk-sharing mechanisms with SMEs. This can include the development of financial products that share certain risks, making it more feasible for SMEs to manage and navigate potential challenges. There's also training and education. So financial institutions can offer training and educational programs to SMEs on risk management best practices. This empowers SMEs to independently identify and address risks and fosters a culture of risk awareness within the business. And within that entire cycle, of course, there's monitoring and feedback. So regular monitoring and feedback mechanisms should be established. Financial institutions can work closely with SMEs to assess the effectiveness of risk management strategies, identify emerging risks, and adjust mitigation measures accordingly. So then we've got technology adoption after monitoring and feedback. Collaborative efforts can include the adoption of technology for risk management. Financial institutions can leverage data analytics and digital tools to assess and monitor risks, providing SMEs with real-time insights for better decision-making. And lastly, we have government support. Again, this is a point that you've heard before, but this is essential because financial institutions and SMEs can advocate for government support in creating an environment conducive to risk management. This may include regulatory frameworks that incentivize risk-aware behavior and provide support during economic downturns. By fostering collaboration and a shared commitment to risk management, financial institutions and SMEs can create a more resilient business ecosystem. This collaboration is particularly critical in the context of SMEs, where the impact of risks can be more pronounced due to resource constraints. Ultimately, a proactive and collaborative approach to research management enhances the overall resilience and sustainability of SMEs. Now, subsequently, we have Islamic financing options. And Islamic financing options are becoming increasingly popular in Pakistan, reflecting a growing demand for financial solutions that adhere to Sharia principles. Small and medium enterprises can benefit from being aware of Islamic financing options, as these align with Islamic business ethics and provide alternative methods of accessing capital. Two common Islamic financing structures are Mudarba and Murabaha. So if we were to analyze the basic Islamic financing principles, we'd look at things like Sharia compliance, and we would look at whether or not Islamic financing operates within the framework of Sharia principles, which prohibit the payment or receipt of interest and riba and encourage ethical and socially responsible financial practices. And of course, there's the idea of risk and profit and loss sharing. And in this case, Islamic finance emphasizes risk sharing and profit and loss sharing. It emphasizes these arrangements, ensuring that both the financier and the entrepreneur have a stake in the success of the business. Then we have Mudarba. So if we were to look at the primary instruments, we talk about Mudarbas, which is a profit-sharing partnership where one party provides the capital while the other party manages the business, and profits are shared according to pre-agreed ratios, but losses, if any, are borne by the investor. And from an SME perspective, this is important because SMEs can enter into Mudarba agreements with Islamic financial institutions to raise capital for their ventures. And this structure is particularly suitable for businesses where the entrepreneur has the expertise to manage operations and the financier is willing to provide the necessary capital. The second type of instrument is a murabaha instrument, which is a cost plus profit arrangement. And in this structure, the financier purchases a commodity at the request of the customer and sells it to the customer at a markup. And the cost and profit margin are transparent and agreed upon upfront. And if we look at this from an SME perspective, murabaha is commonly used for short-term trade financing and working capital needs. So it's possible for SMEs to use murabaha to secure financing for purchasing assets or inventory without resorting to conventional interest-based loans. Another instrument is an ijara, which is a leasing arrangement where the financier purchases an asset and leases it to the customer for an agreed period in rent. At the end of the lease term, ownership of the asset may be transferred to the lessee. And there's many other instruments as such that can be used by SMEs. And this is important because when we consider this alternative financing option, we have to remember ethical considerations. So socially responsible finance is something that aligns here because Islamic finance aligns with ethical considerations, promoting responsible and socially conscious financial practices. SMEs can position themselves as socially responsible entities by opting for Islamic financing options. And of course, at the end of the day, this can result in a collaboration with Islamic financial institutions. Okay, so this is important because it enhances engagement with institutions. The SMEs should actively engage with Islamic financial institutions and explore partnerships that facilitate the application of Islamic financing structures tailored to their specific needs. In conclusion, the awareness and utilization of Islamic financing options, such as mudarba and murabaha, can provide SMEs in Pakistan with ethical and Sharia-compliant alternatives for raising capital and meeting their financial needs. As the Islamic finance sector continues to evolve, SMEs can benefit from exploring a range of Islamic financing instruments that align with their business objectives and values. After Islamic financing options, we can actually also identify the role of capacity building. And capacity building for small and medium enterprises is a critical component of fostering their long-term success and sustainability. In the context of Pakistan, where SMEs play a significant role in the economy, initiatives aimed at enhancing the capabilities of these businesses are essential. An elaboration of the importance of capacity building and the roles that financial institutions and the government agencies play in this process include financial management. SMEs often face challenges in managing their finances effectively, and capacity building in financial management helps SMEs develop skills in budgeting, cash flow management, financial reporting, and accessing appropriate financing options. Government agencies may organize workshops, seminars, and training programs to educate SMEs on sound financial practices. These initiatives can be tailored to address the specific financial challenges faced by SMEs in Pakistan. There's also marketing strategies. And many SMEs struggle with creating and implementing effective marketing strategies. Capacity building in marketing equips businesses with the skills to identify target markets, develop marketing plans, and utilize digital marketing tools. In terms of financial institution support, financial institutions can collaborate with SMEs to provide guidance on marketing strategies and connect them with resources to enhance their market presence. After marketing strategies, we have operations management. So efficient operations are vital for SMEs to remain competitive. Capacity building and operations management covers areas such as supply chain management, inventory control, and process optimization. Government-sponsored training programs can focus on operations management, addressing common challenges faced by SMEs in Pakistan, including optimizing production processes and improving overall efficiency. There's also technology adoption. Embracing technology is crucial for the competitiveness of SMEs. Capacity building and technology adoption involves training on digital tools, e-commerce platforms, and the use of technology to streamline business operations. The government can introduce incentives and programs to encourage SMEs to adopt technology. This may include subsidies for digital infrastructure and training programs on digital literacy. Access to information is next. Many SMEs may lack access to up-to-date information on market trends, industry best practices, and regulatory changes. Capacity building involves providing SMEs with the knowledge and resources to stay informed. Financial institutions can facilitate access to information by partnering with industry experts and knowledge-sharing platforms. This collaboration can empower SMEs with insights that contribute to better decision-making. Entrepreneurial skills development. Building entrepreneurial skills is fundamental for SME owners and managers. Capacity building in this area covers leadership, innovation, risk management, and adaptability. Financial institutions and government agencies can organize training, workshops, and mentorship programs to nurture entrepreneurial skills among SME leaders in Pakistan. Market linkages. Establishing linkages with larger markets can significantly benefit SMEs. Capacity building efforts can focus on helping SMEs understand market dynamics, comply with quality standards, and access larger distribution networks. Government agencies may facilitate market linkages through trade fairs, networking events, and programs that connect SMEs with potential buyers and partners. Sustainable practices. Capacity building in sustainable business practices is becoming increasingly relevant, and SMEs can benefit from training on environmentally friendly practices, social responsibility, and ethical business conduct. The government can incentivize sustainable practices through regulations and policies that reward SMEs for adopting environmentally friendly and socially responsible approaches. Financial literacy is also critical here. Enhancing financial literacy among SMEs is crucial for better financial decision-making. Capacity building in financial literacy covers understanding financial statements, managing credit, and making informed investment decisions. Financial institutions can collaborate with educational institutions and industry associations to offer financial literacy programs for SMEs. And lastly, we have customized training programs. Recognizing the diverse needs of SMEs, capacity building programs should be tailored to address the specific challenges and opportunities within different industries and regions. And government agencies and financial institutions can work collaboratively to design and implement customized training programs that cater to the unique needs of SMEs in various sectors across Pakistan. In summary, capacity building for SMEs in Pakistan is a multifaceted process that involves collaboration between government agencies, financial institutions, industry experts, and educational institutions. By investing in the skills and knowledge of SMEs, Pakistan can strengthen its SME sector, promote economic growth, and contribute to the overall development of the country.